Guys, welcome to this second part of the video on demand and supply. In the previous video I was talking about what demand and supply is, what causes them, how they are formed, and the areas and some of the strategies used in trading demand and supply. So in this video I'm going to be showing you how to identify the demand and supply zone. In the previous video I didn't show you how to mark them, how to identify them, what causes those areas to form. So in this video I'm going to be showing you practically how to mark out potential demand and supply zones, what will help you to understand the areas where demand and supply is going to form. So let's begin. We have different types of demand and supply, right? We have different types of demand and supply, right? So the first one, we have what we call rally-based rally. What rally-based rally means is the market buys, right? Then after the market buys, it ranges for some time, right? Then it continues buying. We call it rally base. This point now, we call it a base. Then we have rally base, what? Rally, right? Then the next one is we have the drop base drop. We have the drop base drop, which is this: the market sells, then it ranges for some time, then it continues selling. Like you can see in this diagram, drop, the road decline, base decline. You see the same thing with drop base drop. So we have drop base drop. That's to say the market sells for some time, right? Ranges, then continues going down. Or even if it doesn't range, it gives a confirmation candle for sell, then it continues to go down. We call that point a base. We mark it out. Then we have rally base drop. Rally base drop simply means that the market buys, then it ranges for some time, then it sells. So we mark out this place as our base, right? Then the last one is we have our drop base rally, meaning that the market sells, right? Then it ranges for some time, then it buys again. So now, if you observe in these four different examples of demand and supply I just gave, you will notice one thing, which is they all have what? A base. They all have a base. Now, this base is what we are going to mark in as our demand and supply. Now, anytime you notice that a market forms a rally, it forms a base and maybe a rally, that is where you now carry your triangle tool and mark out as either your demand or your supply zone. So I'm going to be explaining each and every one of them: the rally base rally, drop base rally, rally base drop, and drop base drop, carefully, so that you understand it very well, right? So now the first one I'm going to be explaining is the rally base rally. Now, if you can see from this diagram now, you will notice that the market went up. I'm coming. Now, the market went up, right? That's to say the market bought, which is the rally, yeah. Then it ranged for some time, which we will now use our rectangle tool and mark as our base. Now, the thing is that anytime you see a rally base rally and you mark out the base, that base becomes what? Your demand zone. You understand? So rally base rally, it is how we get our demand. You understand? Because when one, like I've always been saying before, price is very, very repetitive. What has happened before will happen again. Any area that price has visited before, it will visit again. So now the significance of rally base rally is, now that we have gotten our base now and the market has gone up, anytime the market comes down, there's high chance that if it comes back to this base again, it will sell again. So you understand that now this place now becomes our demand zone. So you understand how we are able to generate our demand zone, right? Now let me give small explanation on it. The rally-based rally is a type of demand zone which forms during an up move or an uptrend, right? They get their name from the market structure which creates the demand zone. In the example above, you can see we have a rally first, then a consolidation, or consolidation means the market ranged for some time, which we called our base, and finally another rally which creates the demand zone. The demand zone, which is this zone we have been marked out, right? Which creates the demand zone itself. A rally-based rally will always form a demand zone. They can never form a supply zone, right? Like I explained here. Remember, it rallies, it ranges, or it consolidates for rallying. Remember, that is where you now carry your triangle to and mark it out as your what? As your demand zone. So that if there's any period, like if you observe in this diagram here, if you have to draw this thing, let me try and draw a straight line. If you have to draw this thing here, you will notice that from this base here, this base straight, the market came and touched this demand zone again and started going up here. But don't worry, I'm going to use our MetaTrader app to show you more practical examples. Then the next one is we have the drop base drop. As we can see in this diagram here, you will notice that the market sold, right? It sold, then formed this base, right? Then continued selling. Our drop, our base, and our drop again, right? So now the thing is that the drop base drop forms our supply zone. Why does it form our supply zone? It sells, right? Consolidates. This is our consolidation, which you now use your triangle to and mark out. Then it drops again. The drop base drop zone forms the supply zone. It can never form the demand zone. So once you are marked out of the supply zone, if peradventure the market continues selling, right, and at any point in future where the market comes around this region of our supply, there's high chance that the market is going to sell because it is a zone. It's a supply zone. So now you have marked it out. Anytime the market is getting close to this region or it enters this region, you can place your pending orders, your sell orders, you understand, or your sell limits, you understand. Or instead, you can, if you don't want to use pending orders, you can wait and see the candlestick confirmation candle that will form in this supply zone, then you sell, you understand. So now we know how to we understand. We have done rally based rally, we have done drop based drop, right? And the next one we need to do is the drop based rally, right? As you can see in this diagram here, we have the drop, right, then the base, then the rally. See, the market sold here, it formed the base, which we mark out as our zone. In this case, it's going to be our demand zone. Then drop base what? Rally. So now we have marked out this point. So if there's any time in future the market comes around this region, right, any time in future the market comes around this region, it makes it easier for us to make trading decisions because we know that around this zone, this is where demand is, this is where the buyers are. So there's high chance that there's going to be massive buy at this point. So you just set your pending orders within this range. Then remember, your stop loss will be below the range, right? Or below the demand zone. Then so that if price reaches this zone and it gets activated, you enter your buyer. And remember, your take profit is going to be the next supply zone in this case. Then the next example, this is another diagram to help you understand better. Remember, see, it dropped, right? Then it formed the base, which is our drop base rally zone, which is the demand zone. Look at this diagram, it has already been marked as our zone, right? And rally. So if, like I said, once it comes back to this zone again, you place your pending orders and you buy. So you see how easy using this demand and supply is to make trade, right? So the drop based rally only forms demand zone, it cannot form supply zone, right? And the fourth one is what? Our rally based drop. Our rally, let me zoom into the diagram so you can see clearly. Our rally based drop, see the market rallies, as in this diagram, rallies, ranges for some time, right? Then forms our base, then it drops. The rally based drop forms what? Our supply zone. It can never form the demand zone. So once you mark it out, once you see this zone, you mark it out so that if price is to come back to this region again, you can sell. You understand? So you can see that this tool makes it easier for you to make trading decisions, right? Make the whole thing easy for you. So just as in this diagram, we have our rally, our base. We mark out the region of our base and our drop. Another thing you need to take note of is the fact that when we talk about the base, it doesn't necessarily mean that the market must range in that point. You understand? There are some times that it will not range. Like in this case now, it didn't range. It rallied, right? Then gave us a bearish engulfing, which is this candlestick pattern here, a bearish engulfing pattern, and dropped. The main thing is that it goes up, forms a sharp peak of price, and goes down. Once this happens, you mark out that sharp peak with your rectangle tool, and it becomes your supply zone, or if it's below, your demand zone. So now you notice that once we have marked out two regions of price, if you want to trade the range trading strategy or the breakout strategy, it makes it easy because you already know the region you are trading in. You already know the place to expect price to reach before you make your trading decisions. So you see how easy it is to use the demand and supply tool to make your trading decisions, right? So just like that. So but I'm going to be explaining what causes these particular zones to form, because they don't just form like that. Something causes them to form, right? So I'm going to be explaining what causes the rally based rally to form, what causes the drop based drop to form, what causes the rally based drop and the drop based rally to form. So I'm going to be explaining the significance, or what is behind it. You understand what causes them to form? I'm going to be explaining it so you understand it. Okay. What creates the drop based drop, which is this drop? Let me use diagram. Drop based drop and rally based rally to form. Okay. What creates the drop based drop and the rally based rally? Both of these zones are created by are calculated because of bank traders taking profits off existing trading positions. Bank traders taking trades off existing positions. Before I explain that, we have two types of traders. We have the institutional traders. And we have retail traders. One, institutional. Two, retail traders. When we talk about the institutional traders, we are talking about big banks. When you keep your money in the bank, the banks use your money to trade. They don't just keep your money in the vault and it remains dormant. They use your money to trade the global financial market or the global stock market, right? They use your money in agriculture, in transportation, in the oil and gas industry. They use your money for different things, right? They use your money for different purposes so that they can make more money. Now, why the retail traders are me and you, people that trade with a small amount of money, are called retail traders. institutional traders are called institutional traders because they trade with large volumes of money. Like banks are institutional traders. When you talk of hedge funds, talk of commercial banks, anybody that any corporation or institution that trades with large volume of money are called institutional traders. Because me and you might be trading with maybe $1,000, $2,000, $3,000, or $5,000 to $10,000 as our trading capital, but those guys, they trade with billions, some billions of dollars, some billions of naira, some millions of dollars. So you see that the amount of money used as trading volume, when you compare the retail traders to the institutional traders, is very high. You understand? So the rally based rally and drop based rally is formed as a result of when institutional traders or bank traders are taking profits. Now, this is a diagram for rally based rally, then drop based drop, right? Now, when you say they're taking profit, it means that the market was they made the market to buy, right? They make the market to buy. Then this consolidation, which is the base before the further rally, right? It means that this is where they bought, right? They bought here, and when they bought, the market rallied. Now, this consolidation means they are taking profits. You know what to take profit? It means to close some trades. So since they are closing some of their trades, the volatility in the market reduced. That is to say, there was no more money. That's why you see the market still ranging. Then this other rally formed because they bought again. The rally here means they bought again. You understand? Why? It's just the same principle that applies for drop based drop. They sold the market, institutional traders sold the market, right? Then it ranged. This point where it's ranging means they are taking profit, right? Then after they were done taking profit, they sold again. You understand? So this is just the principle behind the rally based rally and the drop based drop. So one thing you need to understand is that there's a war between the retail traders and the institutional traders, right? So the war is, it is either you are making profit and they are making loss, or you are making loss and they are making profit. So that's why you see that knowledge is very, very important, so that you know what is at play. You see, most people that make massive losses is because they don't understand some of the principles behind this thing, or the principles behind the workings of price movement. They trade it like it's a bet and jar. They enter trades like it's a gamble, and if you make trading decisions like that, you end up losing a lot of money in the long run, right? So you need to understand some of all these core principles or principles behind price movements. You understand? So that you make careless trading decisions. You understand? So this is what creates the rally based rally and drop based drop. It is because institutional traders or banks or people that trade with large volume of money are taking profits. Another thing you need to know is that if in a case, let's say the retail traders, which is me and you, we are buying the market, right? We are buying it, and the institutional traders say that they want to sell it. This we are buying, right? And institutional traders, so they want to sell. The market will immediately sell, no matter what the retail traders are doing, because if the total volume of money that is being used by all the retail traders is, let's say $1 billion, right? $1 billion. Then the total volume of money that is used by the retail traders, by the institutional traders, maybe the money they use to sell is around, let's say, $10 billion. The market will definitely sell because they have a larger volume of money. So you see why it is actually a war between you and them. So the idea is to understand what the institutional traders are doing, so that you can know where to enter, where not to enter, because there are some trading positions that are actually traps by institutional traders to eat the money of retail traders. You understand? So some of all these things, you need to understand them. That is why, like for me as a person, I prefer using demand and supply to make my trading decisions. And I've noticed that over the years, I've noticed that demand and supply works very well with gold. So I only trade gold because demand and supply works almost perfectly with gold. Once gold reaches some particular price levels, you usually notice very massive spike in price. When I'm done with this explanation, I will show you practical example of my analysis on gold, I think for the past year, right? So that you can see practically for yourself how gold respects demand and supply. I will also show examples for other pairs so that it will be easier for you to understand, right? So remember, rally-based rally, drop-based drop forms as a result of bank traders or institutional traders taking profits, right? So let me explain the other how the other ones form, which is rally-based drop and drop-based rally. Okay, before I explain for drop-based rally and rally-based drop, let me just give small further explanation to what I just said about what the bank or institutional traders are doing. Now in this diagram, this is the diagram for rally-based rally. Now let me just read through some of the things I wrote here. It said before the rally, we had the bank traders placing long trades in the consolidation. When the bank traders placing long trades in the consolidation, this was the consolidation, right? Then the bank traders place long buys, which is this, right, before this base. Now let me explain to you what is happening here. Now, when the banks buy orders consumed the retail traders sell orders, the market rallied higher. Now the bank traders are in profitable trades. The next thing they will want to do is to secure some of their profits. When they decide to do this, they consume all of the buy orders coming into the market from retail traders who have begun entering long trades due to size of the rally. I just read this point now, right? So now, what this means is that the market was consolidating, right? Now, in this process of consolidation, some people thought that the market is going to sell down, right? When by thinking the market will sell down, they entered sales. Now, the banks have noticed that people have placed sell orders. Then they decided to do what? They bought. Now, in the process of buying, they have eaten all the money of people that sold here, right? Now that they have bought and the market is rallying up, what will they now do? They are targeting your money again. They begin to take profit. And as they are taking profit, right? They are taking profit. They will push price down a little bit so that some people will think that the market is going to sell again. Now, by thinking the market is going to sell again, they will now decide to buy and take out the money of people that are sold. You understand? So they have taken people's money here. They have taken people's money here. You understand? That is people that thought the market will sell in this point, this down point. People that thought the market will sell in this down point. And there are times again that when the market has started in this particular point that the base is forming, when they have taken the sell, the market, they made the market go down a little bit when they are taking profit, and people decided to start selling, they will now decide to buy. And by buying now, what it means is that they have taken out people that were selling and made them to lose money, and they will now push price further up. So you see that you are actually in a war between there's actually a war between the retail traders and the institutional traders. That is why you see knowledge is very, very important. Let's read further. It said the consumption of buy orders means that the market makes a small move lower, which I just explained now. This creates the base which the demand zone eventually forms. This is our demand zone, remember, which the demand zone eventually forms of. The move lower causes a large number of retail traders who went long on the rally higher to close their trades at a loss, which puts a lot of sell orders into the market. What this means is that, you see, that is why I said you shouldn't buy in between zones. You should wait for it to get to the overbought region or the oversold region if you are making use of stochastic oscillator or relative strength index indicator to help you. Now, anybody that didn't catch this buy with the institutional traders at this point and decided to enter, let's say, are close to this rally, that is, let me zoom in. Let me say, look at this point now. If you didn't catch this trade around this region at the tip of the trade, and let's say you saw that the market has started buying, you saw the massive candles forming, and you decided to buy at this point here, right? You decided to buy at this top. What you just did, you just bought at the top, and look at what they did. As the market was going down, when they started taking profits, it went down. It went down first, right, and formed a base before it went back up. This going down means the person that bought at this top now, at this top, will be in loss, although he's still buying. The trend is clearly a buy, but he bought at the wrong time. So what does this mean for him? It means that now that he bought at the wrong time, he will lose money. When the thing now goes down, remember I said that they will now make the fact that it's going down, they will make it look like the market is changing direction. When it starts going down a little bit, some people begin to enter sell orders, right? Entering sell orders, not knowing that the market is not going down. When the market begins to go down a little bit, then they will now push it back up. They will now buy again with a large amount of equity or large amount of money. Now, in this case now, they have made both people that bought at the wrong time to lose money, people that bought at the wrong time to lose money, and people that went to go and sell at the wrong zone, right? People went to go and sell at the wrong zone to lose money. So you see what the banks are doing. They have made both the buyers and sellers to lose money in this point. You see why it is very, very important to not just know the zones. You need to know the exact zone that is a demand zone, the exact zone that is a supply zone, and you need to know what these bankers are doing by entering at the right point. You understand? First of all, you understand the trend that is at play. If it's a buy trend or a sell trend, understand the zones, your demand zone, your supply zone, and don't fall into the traps of these institutional traders. You understand? So this is just what's at play here, right? Now, they said with two sets of retail traders putting the same type of orders in the market sells, the banks now begin buying again. This point here, the banks now begin buying again, knowing full well, knowing they will make the markets move higher, and the process cause everybody who sold on the move lower to close their trades at a loss, which ends up being the bank profit. So you see that there's a battle between the institutional traders and the retail traders. Just like if you are playing, I don't know if you know this game, tug of war. In tug of war, you will see there are two sets of people. This is the rope, right? You see two sets of people in tug of war. Different set of people in tug of war. There are people in this side too that are drawing the rope on this side in this game, tug of war. Now, let's assume this is a battle between the retail traders and the institutional. Let's say these guys here are the retail guys, are the retail traders, are the retail guys, which is me and you, and these guys here are the institutional traders. Institutional traders. Even from this diagram, you will know that the institutional traders will win you, because let's assume their number represents equity, which is money, represents equity, which is money, right? The number of people represent equity, which is money. The guys that have more equity will most likely win the guys that have less equity, less money, because of volume. Number is a very, very important thing in financial markets. So now what you need to do as a good or wise trader is you need to know what these guys are doing. So if you, let's say you are on this side, on the outside, you need to know what they are doing, so that any direction they are going, you will know how to join and be profitable. You understand? Because you cannot fight them. They have large volume of money. Let's say you are using $1,000 or maybe $10,000 to trade, and these guys are using a large volume of money, sometimes in billions of dollars, to trade. You need to know how to position yourself well so that you'll be able to benefit from the trend. You understand? So that's just the explanation for rally based rally and drop based drop. So we are going to be going into um, the drop based rally and rally based drop. But before I go into that, let me give small explanation so you can understand better what is at play. Okay, another thing you need to note is that let me read through this. The size of the long trades that the bank traders are able to place or can place is dependent on how big the pullback or consolidation caused by the profit taking is. When I talk about long trades, I just mean if you say long, it means to buy. If you say consolidation, it means to range. Then if you say short, it means to sell, right? It means to sell. Now, the size of the long trades the banks can place is dependent on how big the pullback or consolidation caused by the profit taking is, right? Now, then, say in the example above, the market only manages to pause or consolidate for a small length of time, which means that the bank are only able to place a small number of buy trades. If the profit taking caused a big pullback down to the 50% retracement level of the initial rally higher, the banks would have been able to place much bigger buy trades because more retail traders would have been selling, and it's likely the second rally would have consumed could have continued for significantly longer amount of time. Now, what this statement from here to here means is that, let me go back to the diagram. Now, in this diagram, right, we see that this rally, the market rallied for this time, right? Rallied, right? Before it came down a little bit. And but what the statement I just read is that we can see that this consolidation or this taking profits that the banks did not cause the market to go down very low. It didn't cause the market to go down very low, which means that the banks can only buy back for a short period of time. If you check very well, you will notice that the rally here, right, is smaller than the rally here. You know, like I said, the battle is between retail traders and institutional traders, right? I said that the battle is between retail traders and institutional traders. Now, the fact that this pullback or this pullback that was caused by their profit taking did not go down very well. When I say it means that they cannot buy for a very long period of time. What it just means is that the fact that it not go down very long, you know, the people that as it's going down like this, retail traders, me and you, most retail traders are placing sell orders because they think the market is going down. So if they pull back, cause the market to go lower, that means more retail traders have entered. It was going down, let's say it went down to 50%. What it means is that some people bought here, some retail traders bought here, they make small profit. Some retail traders sold here. People say selling, right? As they pull back, which was caused by the profit taking of the banks, as it was going down. If it went down a little bit, it means that the moment they decide to buy, it means that they'll be able to take the profit of a lot of retail traders, which is always their target. If it went down and it rallies back, if it went down to like 50%, it means that they will take the whole money of people that sold from this point to this point, which is the retail traders, before it rallies back, which gives them more momentum to buy for a long period of time. But in this example here, it only sold for a short, or the consolidation only made the market go down for a short period of time. Or if you trade crypto, we say it only dipped. It only dipped for a short period of time. It only dipped for a short period of time, meaning that market only went down for a short period of time, right? For a short period of time. So now, if it goes down further and further, the consolidation, that's when it took profit, it went down further and further. The moment they buy, they take, because many traders would have started placing sell orders, started selling, they will take a lot of money of retail traders. So that's just the psychology behind this explanation I gave. Then this other one here says the banks take profit of sell positions, which I just explained now, which stop the market from falling. Then as the banks take profits of sell positions, which stops the market from falling. Then as the market begins to pull back against the trend, the retail traders who sold late, remember, no matter what you do, don't sell late, because institutional traders will eat your money. Who sold late into the downtrend close their trades at a loss because they sold late, right? And reversal traders begin placing buy orders, begin placing buy trades because they believe the trend is changing. Both of these traders are putting buy orders into the market. The banks used to get more sell trades placed, which eventually causes the market to drop and makes all the traders who place buy trades to lose money, right? So in the next video, I'm going to be explaining what causes the rally based drop. The length of this video is already getting longer, and I don't want it to be that long so that it does not get boring, right? So I'm going to be explaining the drop, the rally based drop and drop based drop in the next video. Don't forget to subscribe to the channel and like the video, and that is to appreciate the work I am putting in helping people to learn how to trade for free. And if you have anybody that wants to learn how to trade for free, kindly share our YouTube channel with them. Then if you have any questions from the videos I've been dropping, I am going to attach our WhatsApp group link to this video, so you can join our WhatsApp group and ask questions there. There are a lot of professional traders there that will explain for you in any area you might have issue, right? So thank you for your time.